let's talk more about these numbers, how they're affecting the market. I want to bring in Jens Nordvig, Exante Data founder and CEO, and Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Guys, good to see you. Thanks so much for being here. Appreciate it.
Yeah, like this is kind of a hectic time to do an interview right with the numbers coming
out. Yeah, it's fun, right?
This is a huge number, I think. Like, we've not had a number less than 0.3 on the core in 2 years, right? And actually, if you look at the unrounded numbers, this is actually pretty close to 0.1 if you look at the unrounded numbers. So this is a pretty big deal, right? If the Fed in the coming months can see that service price inflation is actually starting to get closer to target, the narrative, I think, can change dramatically. We're seeing pretty big moves in the market, right? The yield curve had already moved kind of a little bit in anticipation of this number, and now we're down another kind of 10 basis points around the whole yield curve. So I think this is a pretty important number. And I think that the market will be digesting it for a little bit.
Yeah, Jordan, how did this kind of pair against some of your expectations coming into the report?
Sure, I'd strongly agree. I think this is a welcome print from the Fed. Maybe they're not fist bumping just yet, and all clear on inflation, but it's certainly a good sign. You know, I had anticipated that the core number was going to be a little bit hotter than anticipated, and specifically, the Fed's been harping on this core services ex-shelter inflation. And what's been interesting, the last several readings, a big chunk of that was transportation services, and then specifically leased cars and trucks. Motor vehicle insurance, as well as auto body maintenance. Certainly lease payments are kind of impacted by the Fed. The Fed keeps raising rates. That's kind of shooting themselves in the foot a little bit there. But elsewhere, it was encouraging to see sort of used car comes down. That should have an impact on insurance payments. And then actually the challenge with the auto body scenario is labor. It's a labor challenge. It's hard to find a mechanic. It seems like it takes 6 weeks to get your back bumper fixed. So that could remain a little bit sticky, but again, still in aggregate, on balance, welcome numbers in terms of the trajectory for inflation for the Fed.
It seems like you're speaking from unwelcome experience there when you talk about it taking a long time to get your bumper fixed. Anything else that stands out to you, Jens, in the components and where we are seeing things abate and things still be sticky?
So when I look at the CPI release, I like to look at literally all the components and see the whole distribution of what's going on, and then look at, okay, what's the middle of this distribution? We've now had 3 months where the middle of all goods has less than 2% inflation. 3 months now. So in the last couple of months, it was because of goods, right? Like, we know that there's a bunch of goods prices that are falling, right? But overall, the whole basket together, we have 3 months where the middle of the basket is less than 2%. So clearly things are changing, right? Is it enough for the Fed? We can have that debate. But we're entering a new regime where this incredibly elevated inflation, well above target, is potentially behind us. So that's, I think, is a pretty big deal.
Yeah, and that's what a lot of consumers are wondering, too. Is the worst of inflation behind us? The Fed's not going to be fist bumping quite yet, but at the same time, does it change the tenor of the conversation that they're having, Jordan?
Well, I think it does. I think what it allows them to do is maybe get one more hike, and at the end of the month, they're kind of embracing this skip hike pace, so that I think they intended to already skip in September, potentially come back and hike again in November. I think we continue to see this type of progress in inflation. I think we can kind of put that November hike to bed, and the Fed can finally stay on pause potentially through the end of the year. I guess my concern is the Fed's obsession with 2%. I don't think 3% inflation is all that bad, and certainly not a number in which policymakers need to overreact to. But I do think the challenge is maybe going from 3 to 2, particularly when we start to get a 3 handle on the core number. Getting down to 2 might be a little bit harder, and I think that's the risk where the Fed might overreact and maybe want to pencil another rate hike in November, especially if labor markets are still pretty tight.
Absolutely.
Yeah, I think when I look at what's going on in the economy, right, so we had an incredible amount of focus on used car prices, and obviously we don't want to have like the CPI release just being about what used cars are costing, but there's actually kind of an economic meaning to what's going on with these used cars, right? It is because it is so much more expensive to finance any kind of car purchases, right, that demand is changing. And to be honest, like, the surprise we've had this year is that the much high interest rates have not been creating like a dramatic credit crunch, right? So I think the next couple of months the degree to which these high interest rates are going to really feed into certain parts of the economy that are interest rate sensitive is key. And I think we got one very important data point this week before the CPI, and that was that the consumer credit is now slowing dramatically. We had last year kind of a consumer credit boom because there was no need to borrow because of all the transfers in the COVID period, but there was borrowing last year, and that's now slowing. The higher rates are starting to bite, right? So I think if we have a combination where the headline inflation pressure is coming down, the core inflation pressure is coming down, and in addition to that, we can start to see that actually the consumer is feeling squeezed, cannot obtain the credit that they obtained last year, then the savings rate will actually go up, consumption will go down, and that combination, I think, is what's going to move the Fed.
I think that's a really interesting point because for a long time we were worried about the supply side driven inflation, right? And the fact that Fed hikes weren't going to be impacting the supply side. Now we're seeing hikes finally impacting the demand side on the consumer, and that could very well be is what monetary policy is for. What these higher rates are finally doing, and that should bring that inflation number continuing to trend lower.
What does this report do, if anything, to your strategy, right? Does it, I mean, not just this number, but if we continue to see inflation maybe moderate more quickly than expected, does that change your thinking at all?
Interestingly, I think it's bullish for stocks and it's bullish for bonds. I think it's bullish for bonds, so certainly long-term rates can come down a little bit on the back of lower inflation. And I think it eases off some of the pressures on overall consumers in terms of purchasing power. And so that potentially kind of softens the earnings blow in maybe the back half of the year if we get slower growth, modest recession potentially playing out. So I actually think this is pretty bullish across the board.
Yeah, what about you, Jens? I mean, does a report like this still signal Q3 2023 recession?
I'm not sure the CPI being lower is what's going to trigger the recession, right? Like in a way that means that the Fed can kind of stop hiking a little bit earlier, right? But obviously reflects something that's going on in the economy that might mean that we already had softness. In terms of strategy, right? I think it's very important for the dollar. Like I did a note last night. Maybe if I look a little bit tired now, it's because I was working on that last night. But I think for the dollar outlook, this is really important. We've already seen the dollar sort of started to surprise a lot of people over the last couple of weeks, being weaker than they thought. And the only reason the dollar was really holding up had to do with the Fed being super tight, right? So if that is now in question, two-year rates have rallied like almost 15 basis points on this number, right? So we're talking about pretty big moves, and this is really creating a problem for the dollar. So I think how you want to trade international assets and the dollar is heavily influenced by this.
All right, guys, before we let you go, Jordan, any last, we'll give you the last word here as we sort of like let this sink in, the CPI report coming in a little bit more moderate than expected.
Yeah, I think the Fed should take this as an opportunity to maybe dial back some of the hawkish rhetoric. Obviously, you've seen now financial conditions more broadly are relatively at average over the long run average, and not necessarily tight. They're not necessarily restrictive. But I think if they can adopt a less hawkish tone, we could actually still be in that soft landing camp. I mean, obviously, businesses are maybe pulling back on business investment and capex, so that's going to weigh on growth. You now have a limit, a cap on non-discretionary spending, and so fiscal spending is going to be neutral to modestly a drag on GDP. Also, once we get student loan payments ramping back up, that's going to be a slight drag as well. It's really going to be the consumer that can potentially keep things afloat here and engineer that kind of softish or very modest, shallow type of recession. And so I think the Fed's, again, got to adopt their bedside manner and be a little bit more patient here and not overreact.
All right. Excellent stuff. We're going to have much more to discuss on this throughout the rest of the day here on Yahoo Finance.